Responsibility accounting gives us our first look at budgeting and controls that we use to run an organization. We'll go through how to look at budgets, what a flexible budget is, as well as look at various differences and a few ways to evaluate some investment opportunities. A budget is developed by management so you can compare what you expect to happen to what actually happens. Those expectations just come from previous experience and what you know is the norm. We look at two different types of budget. A static budget is based on one projected level of activity, compared to a flexible budget, which makes the variable cost flex to show and be comparable to actual activity, kind of like comparing apples to apples since it's based on the same level of activity. Here we take a closer look at how to build that flexible budget. You're going to take that variable cost per unit and multiply it by your actual level of activity. That'll give you your total variable costs. Remember, your fixed costs in total do not change. So we'll add those fixed costs to the variable costs to get our total budgeted costs. If you do need to determine your variable cost per unit, you're going to take that static budget and look at the total variable cost there divided by what level of activity that was based upon to get your variable cost per unit. After we have built this flexible budget and we're comparing apples to apples, now we can look at the differences. A favorable difference occurs when the cost is less than we expected at the actual level of activity. An unfavorable difference occurs when the cost is more than expected. So favorable means we spent less than we thought we were going to have to. Unfavorable means we spent more than we thought we were going to have to. The first thing we need to do is understand decentralization. To understand this, let's take a look at a comparison between a centralized company and a decentralized company. A centralized company an example is Apple, where you have one leader. This one leader is making the decisions for the whole company, and everyone follows that person's lead. Whereas you have Johnson & Johnson, which is an example of a decentralized organization. Under Johnson & Johnson, they still have one company president, but that president empowers multiple leaders to make these decisions for each division or department. Some advantages of decentralization are that it provides excellent training for the managers. It allows that people who are working in the area to make the decision for that area. And it helps actually retain managers because people feel empowered and have the authority to make these decisions. Some disadvantages are that if a manager makes the wrong decision, then it might affect the whole company. And also that it is training these managers really well so that they are more marketable to other companies. To really get a good idea of how a decentralized organization works, take a quick look at this YouTube video about Johnson & Johnson. It gives great benefits of decentralization and explains it really well. You can watch about the first 5 minutes of it to really get a good idea of decentralization. When we talk about controllable versus non-controllable costs, what we're referring to is what level of responsibility are these costs at. All costs are controllable by top management, but as it moves down the levels of management, fewer costs are controllable by that level. We also refer to management by exception, which means that we're reviewing only differences in actual versus planned activities that stand out. And we also look at responsibility centers. These centers will look at which one have a direct impact of processing these established goals that we have set. When we talk about decision-making authority, we also need to talk about responsibility accounting. under responsibility accounting, what we have is responsibility centers. This allows for people to make decisions over certain centers of our business. We'll have 3 different centers. We have a cost center, which has responsibility over costs. We have our profit center, which has responsibility over revenues and costs. And then we have an investment center, which has responsibility over all revenues, costs, and investments in the assets of the organization. Within the cost and profit centers, we can break this down into the overall organization, within divisions, or even departments. For example, in a university, we would have a cost center for the university as a whole. Then we'd also have a cost center within the college, a college piece of that university, and then we'd also have a cost center within the department of the college piece of the university. In the profit centers, this also applies. When we talk about profit centers, we are looking at those controllable revenues and controllable expenses and what decisions can be made to increase those revenues or decrease those expenses where as needed. The responsibility report shows the budgeted and actual controllable revenues and costs. These controllable costs are important because what we want to eventually determine is our controllable margin. If we take our sales minus our variable costs, that's our contribution margin. That should be familiar to you. But now we're going to subtract that controllable fixed costs, which then equals your controllable margin. This will be used in various equations to determine how to evaluate a project. Knowing that controllable margin helps us to look at different ways to evaluate an investment. The first is the return on investment, or ROI. ROI measures the ability to utilize its operating assets to generate income. So, to determine our ROI, we take our controllable margin and divide by average operating assets. For example, if our controllable margin is $400,000 and our average operating assets are $1.6 million, we would divide $400,000 by $1.6 million, showing that we're getting a 25% return on investment. We would compare this to what is our normal accepted return on investment to evaluate whether we should accept this project that we're considering or just to see how our operations are doing. There are several ways that we can improve our ROI, and that's just based on this equation. If we reduce expenses, it would increase our controllable margin. If we increase sales, it would increase our controllable margin, which would then increase our ROI. Also, if we reduce our operating assets, that's also going to increase our ROI. Your ROI just tells you the return that you're going to get on an investment, whereas your residual income takes into consideration what you expect your return to be or what your minimum rate of return is. So, residual income evaluates how much money you have left over beyond what you expect to happen. You're going to take your controllable margin and subtract your minimum rate of return times your average operating assets, and this gives you your residual income. So let's take a quick look at how to perform this residual income calculation. So they give us a wholesale division of Peanut Company. They have an income of $87,000, assets of $240,000, and a minimum acceptable rate of return on assets of 12%. To get to that residual income, we would take our invested assets, which here is $240,000, multiply that by our minimum rate of return, which is 12%. And we're going to compare that to what our actual income is. So here it would be $87,000 minus that $28,800, which we got again from taking $240,000 times 12%. And the difference is our residual income, or what kind of cushion we have over what we expect to get out of our investment.